Good afternoon and welcome to everyone joining this session. My name is Beju Shah and I'm the head of the IBEAS Innovation Hub Nordic Centre in Stockholm. Today I'm privileged to be moderating this session, exploring the question, does decentralized finance, or DeFi, need sovereign money? Decentralized finance, DeFi, refers to financial applications run by smart contracts on a blockchain. DeFi aims to provide financial services without centralized intermediaries by operating through automated protocols on blockchains. One DeFi building block, stablecoins, plays a role in facilitating stable fund transfers across platforms and between users. They allow participants in the DeFi market to use more stable assets for financial services instead of more volatile ones like Bitcoin or other cryptocurrencies. They also act as a bridge between the crypto and the traditional financial systems, i.e. fiat currencies. Can this mechanism help mitigate the settlement risk which comes as nature in payments? And could central bank money in the form of a CBDC, for example, provide better functionality to prevent the risk? This session explores the role of cash settlement for DeFi transactions, the role central bank money might play in settlement for DeFi, as well as the risks and opportunities. So to tackle the question, does DeFi need sovereign money? We are honoured to have an outstanding panel, and I will introduce our distinguished panellists in turn. I'll start by introducing Eddie Yu, who is the Chief Executive of the Hong Kong Monetary Authority. Next, we have Jill Gunter, who is co-founder and Chief Strategy Officer at Espresso Systems. And finally, Brian Brooks, who is CEO of Bitfury. Thank you to all of you for joining us today to share your thoughts and insights. So to begin, I'd like to start with Eddie. DeFi is a source of great deal of attention in financial markets and increasingly so amongst regulators. So from your perspective, what benefits and opportunities do you see that DeFi could offer financial markets?
Thank you very much, Beju, first for having me on this panel to talk about DeFi, which is quite an exciting area in finance. The market is still very small, but it's been developing very fast in the last few years alongside crypto assets. In just 2 years, we've seen the DeFi market growing from scratch to more than $100 billion in total value locked. And for many developers and users, DeFi offers, as I see it, at least 2 main benefits given its unique features, which are permissionless, non-custodial, open source, and composability. First, DeFi could offer the potential to improve efficiency and reduce costs for users by adopting a decentralized structure that does not require intermediaries. As you said, the transactions of DeFi on the DeFi protocols are typically self-executed using smart contracts. Second, many users actually value DeFi's potential also in promoting innovation and competition, especially given the composability nature of DeFi protocols, meaning that the components of DeFi protocols can actually be combined or stacked together to create innovative new financial products or services. It's a bit like a financial Lego or DeFi Lego, where you can just build what you want using others' work in the open source environment. And currently it's still new, and the major assets in DeFi are mainly crypto assets and stable coins, with different platforms coming up to provide services like lending, trading, or asset management. And with the rapid increase in crypto assets in the last few years, DeFi in a way emerges as part of the crypto ecosystem to provide investors with a means to generate return or use from their own crypto holdings through lending or trading. There is, however, as I see it, some potential for DeFi to develop further innovations in activities that might be a little more linked to the real economy, for example, in trading and buying art, in the fractionalization of asset ownership, or in the tokenization of capital market instruments. And these are already starting to happen. So yes, I'm attracted in particular to this innovation part of the DeFi development.
Thank you very much. Now, flipping that question around, what aspects of DeFi keep you awake at night, so to speak, and what emerging risks posed by DeFi worry you the most?
There are actually not many things that will keep me awake at night. I sleep quite well. But on the risk of DeFi, I would group them in three broad categories: market integrity or market conduct, financial stability risk of DeFi platforms itself, and also spillovers to the financial system, the broader financial system. And this last one, the spillover risk arising from the increasing interconnectedness between DeFi and traditional finance is, to me, the more important one. There are two spillover channels, as I said. The first channel is through stablecoins that you mentioned, which serve as a bridge between DeFi and traditional finance. As part of their design, most issuers of stablecoins are holding traditional liquid assets as part of their backing arrangement. For example, one popular stablecoin is said to hold $30 billion in commercial papers, ranking it as the 7th largest holder of those instruments globally. And just imagine a run or mass redemption event on these stablecoins, which has significant holdings on those papers. It could easily cause significant disruption in the short-term credit markets. And the growth of stablecoin is extremely fast as well. You know, you're talking about 6 times market increase in market cap just last year. And this growth sometimes is concentrated in a few dominant players. And this could quickly become systemic through the holding of their backing assets. So I do agree with many, especially in the central banking circle, that there is an urgency in ensuring that stablecoins are properly regulated under a coordinated international approach. The second spillover channel is through the banks, which provide financial services to crypto companies, and they're also acting as a direct linkage between crypto e-wallets and the bank accounts. Indirectly, banks are also providing services to their clients, whether you're talking about family office or hedge funds, which are the main institutional investors in the crypto market. So this increasing interconnectedness and the potential risk of spillover should warrant our closer attention. Just a very quick word on the financial stability risk of the DeFi platforms. Apart from run risk or leverage that you also see in traditional finance, I would be a little more concerned about new risks that come from the nature and the design of DeFi. For example, coding and cyber risks arising from the heavy reliance on smart contracts, and also the possibility of concentration of decision-making powers in the hands of only a few entities, typically the developers, because of the unique way that DeFi protocols are governed on the Ethereum blockchains. And lastly, on market integrity more broadly, because DeFi actually presents an effort to replicate or mimic the functions of traditional finance. So some of the legal compliance risks that we see in traditional finance is also present in the DeFi ecosystem, including, for example, the risk of fraud, money laundering, terrorist financing, and also customers and users are actually not adequately protected because of the lack of appropriate investment protection requirements. So yes, while DeFi has demonstrated great potential of innovation, it's also important for regulators to effectively guard against these potential risks that I just talked about.
Great, thank you very much, Eddie. I'd like to now turn to Jill. So from your perspective as an investor, what excites you about DeFi?
Yeah, well, I think Eddie just gave a fantastic summary of a lot of the key benefits that DeFi can offer and is already offering both to developers and consumers around the world. And that last point is one that I want to touch on because I think that the global nature of cryptocurrency in general and of DeFi products specifically is an important one. You know, we're seeing markets be opened up and become accessible globally in a way that was previously either impossible or not really invested in terms of the development in that direction in the traditional financial system. And I think that, to me, if I was to sum it up in one or two words, it really comes back to that open nature and also the accessible nature of what DeFi is bringing, again, both to consumers and to builders. On the building side, I think that the unleashing of innovation that we've seen grow out of DeFi has been a phenomenal phenomenon, both from the investing perspective, which is a seat that I've been in. The amount of value creation that's happened out of DeFi over just the last couple of years alone has been incredible. And that value, I believe, is really underpinned by both the value being delivered to consumers today and also the promise of the future growth. And so, to touch on that value being delivered to consumers today, for the first time in recent history, we're seeing the ability for consumers to access lending products, trading products, investment products, if you want to call them that, although, as Eddie rightly points out, a lot of this is still very much grounded just in cryptocurrency markets, not yet being tied or linked back to what one might call the real economy or traditional financial assets. But this access has been unlocked for people globally, again, in a way that historically has not been the case or not been possible. And that's just really exciting to see, both from an investing perspective again, but also as a consumer of these things. We're upending with DeFi a lot of the traditional assumptions about what's needed in order to take out a loan, in order to borrow, in order to be a lender, what's needed in order to access very liquid trading markets, what's needed to be able to seek return on assets or wealth. Now, I think that, and I suspect that we'll get there in a moment, but there's a lot that's needed in terms of oversight and consumer protection around all of these things. But I would just highlight once more that whereas so many other areas of the economy and of productive growth over the last couple of decades has been driven by open software development. Again, if you look at sort of the early days of the internet and the explosion of innovation that we saw there, going back to the early 2000s and all throughout that decade, we have not yet seen that up until recently come to the financial system and come to financial innovation. And we can talk about sort of both the necessary gatekeeping and consumer protection that's gone on there, but also some of the ways in which perhaps today with DeFi, we're finding that some of that was a bit unnecessary and that there is a lot of benefit to be gained also from the open innovation, from the composability, and from, as Eddie mentioned already, the money Legos that are being offered up to builders and developers through these products.
I really like the concept of the Lego, but let's look at this from the other side. So thinking about what are the pitfalls in DeFi for both investors and also regulators in thinking about this innovation. And
Absolutely.
also, from your point of view, where are the top 3 risks presented by DeFi that regulators and central banks should be aware of and prepare for?
Yeah, so I would say that the number one risk that exists out there in general, but certainly also for regulators and policymakers, is just failing to protect consumers. I will highlight there is sort of a misconception out there that, oh, crypto isn't regulated. I suspect, as certainly everyone on this panel and probably many of our speakers today and many in the audience are well aware, crypto is regulated, DeFi is regulated. But I think that, sort of globally, the regulatory environment, policymakers, and also enforcement are still finding better and better ways and frameworks to be able to address issues like consumer protection, and also to be able to enforce and follow up on them effectively. But again, first and foremost, I come back to consumer protection. As with any area that is experiencing rapid growth and innovation, you can go back historically and look at the railroads. You can look at, again, sort of the internet boom and bubble of the early 2000s. You're going to have grifters and scammers come into spaces like this and try to take advantage. We've certainly seen that in crypto. There's no two ways about it. We've certainly seen that in DeFi. And again, I think that this is a really, really important role for regulators and policymakers to take seriously, to come in to protect consumers in this way. On the flip side of that, I would also highlight, so that's number one, consumer protection. On the flip side of that, I would also highlight that there's a real risk for regulators that they fail to protect innovation around all of this, that they over-regulate or indeed under-regulate and fail to provide clarity to builders. I can tell you now, being on the building side, working on developing blockchain-based products, it is just as difficult to build in an environment where there isn't regulatory clarity around where the parameters are and what the ground rules are and what is and is not acceptable, as it is to operate in an environment that feels over-regulated or overly constrained. And so I think that, again, the other side of the coin of consumer protection is failure to protect innovation. And I think that it's just as important for regulators to pay attention to that. And then the third key risk I would highlight, just for regulators and policymakers, is the risk of a failure to get educated. And something that I would really highlight is that I think that it's so important to be having the conversations that we're having here today. I am still in awe of the fact that the BIS is putting together a panel like this, and conversations that are happening again all day today and throughout this series. And I think that it's fantastic that an organization like this is really leading the way in educating policymakers, regulators, and other stakeholders globally. I would also encourage, though, everyone here to, if it's possible within kind of the purview of what you do, to actually go out and experiment with using some of these products. It doesn't have to be sort of much, but I do think that there is a lot of benefit to getting hands-on with them in order to really understand what they can and cannot provide in terms of opportunities. But then again, on the flip side, from the consumer protection angle, just how easy it is as a consumer to make mistakes or to have a misunderstanding of the risks associated with these products. So those are the three that I would highlight: failing to protect consumers, failing to protect innovation, and just what underpins both of those is a failure to really properly get educated.
Thank you very much, Jill. That was fantastic. So turning to Brian, so we've heard the two perspectives from both Eddie and Jill about the risks presented by DeFi. From your point of view, how do you think regulators and central banks should address those risks?
Well, so first of all, thanks so much for having me. I really appreciate the opportunity here. And I'm going to begin by saying what I said when I talked about this topic when I ran the OCC, which is the US's national banking regulator, and what I've seen in the private sector in spades. And that is, we tend as regulators and as human beings to look at the incremental new risks created by any new innovation. And what we don't do a great job of as regulators is to assess the net impact on overall system risk by some of these innovations. So if you think about DeFi, it is clearly true that there are some new risks introduced into the system by the concept of decentralization. Sometimes it means that we're relying on currencies other than sovereign currencies in the case of algorithmic stablecoins and the like. Sometimes it's that we're increasing money laundering risk because we're dealing with unknown counterparties. I mean, there's certainly some new risks that are introduced. On the other hand, there are clearly some risks being taken out of the system. So if you think about lending protocols in DeFi, for example, one of the things going on here is that we're taking away balance sheet risk posed by individual institutions by creating a global source of liquidity, namely all stablecoin holders or all protocol participants or whatever. And that means that the likelihood of institutional contagion, of sort of knock-on institutional failure is lower. You could also argue that there are other more consumer-focused goods being pursued. For example, the reduction in fair lending risk brought about by the fact that credit is being allocated by algorithm rather than by human decision-making. So rarely do we look at these things and say, gee, on net, the risk in the system might be lower, even though there are certain new risks being introduced into the system. And so the first thing I say is we have to do a netting effect, a comprehensive review of risk, not only a review of the new things being introduced by the new technology. I think that is really critically important. In other words, to do a simple cost-benefit analysis. The second thing, of course, that's a little bit broader is there is a little bit of a risk, if you want to think about it as such, to the role that banks play as transmission belts for monetary policy, right? And I think this is one of the reasons why there's such a debate in the world right now between CBDCs and other more centrally controlled means of operating a financial and payment system, and people who are pushing more in the direction of stablecoins, which is more of a user-controlled system. Depending on whether you think central control of the financial system, the payment system in particular, is a good thing or a bad thing, will affect whether you see that as a risk or a benefit. For people who make their careers in crypto, they will point to things like, for example, the issue surrounding donations to the Canadian trucker protest, or to the deplatforming of certain legal but politically controversial industries like oil and gas, as an example of why we need DeFi, right? Because it's the only source available that prevents politicization of the financial and monetary systems, which is something I personally think is very important. But other people would argue that monetary policy has always been a policy tool, hence the name, and it's bad to do anything that takes power away from central banks, in managing those things. And so I think there's a set of kind of a priori value judgments that needs to be made before we can figure out which of these things are features, as they say, and which of these things are bugs.
That's great. So building on that and returning back to Eddie, I'd like to ask Eddie the primary question of this session. Does DeFi need sovereign money?
DeFi is already running without sovereign money or CBDC. So technically, the answer is no. But a further question to ask is whether DeFi will be better off or worse off with CBDCs or sovereign money. And I would argue that it's actually better. For DeFi to further develop or even become more mainstream, I believe that three elements are needed. You need robust and mature technology. You need a good, innovative business model. And importantly, you need trust in the system. And I would argue that in money and payments, central banks remain the best placed institution to generate the trust, even in the digital age. And as in traditional finance, private or commercial money will always have to find a way to connect back to public money. And after all, trust is the foundation of any financial platform, and public money, or simply the ability or promise to convert back into public money, can already carry that trust through good or stressed times. And as I mentioned earlier, DeFi already has two channels to connect back to the financial system through the stablecoins and also the banks. And for these on-ramp, off-ramp activities, CBDC should, in theory, make it easier and also provide more confidence for the users. And the use of CBDC could also build in stability to the DeFi ecosystem itself, avoiding any systemic stress that may be caused by the failure of any major or dominant, even dominant private money provider. And that in turn could provide more comfort for regulators who are concerned about the spillover risk that I talked about earlier. But I can also understand that some users, especially the more fundamental believers or the founders of DeFi, they might be quite put off by the idea of using CBDC in DeFi, which seems to run against the idea of not having a centralized payment authority, and which might also risk stifling innovation in unknowingly. And these users may also be worried that there are certain features of DeFi that may be lost if CBDC were to be used. For example, the anonymity in transactions because of the AML requirements. It's still very much early days. The DeFi space still needs time to mature, and CBDCs are only being explored by different central banks. Although the CBDC projects that we are exploring through the BIS Innovation Hub they actually fit quite well with the DeFi ecosystem development, including, for example, wholesale security settlement, asset tokenization, including green bonds, or the use of DLT for cross-border settlements. So overall, I do see more benefits to integrate the CBDC development into the involvement of DeFi platform, provided that the risks arising from DeFi could be properly managed. And that in turn will depend on the evolution of the regulatory landscape for DeFi, which is quite a complex area as well.
So building on that, looking a bit further ahead, do you think CBDCs and stablecoins could coexist, and if so, provide better financial services for customers?
Well, my immediate answer is yes, but with two big caveats. The first is from a regulatory perspective that we talked about earlier. The key issue is whether the risk of a stablecoin system, especially when it grows bigger, are they suitably addressed to protect the users and the broader financial system in terms of, for example, having the right AML/CFT measures, having safeguards against prudential run risk, or with the right consumer protection measures that Jill talked about. In many ways, if you think about it, stablecoins are actually very similar to payment systems, but because of its nature, it has much bigger room for cross-border regulatory arbitrage. If the risk of stablecoins can be properly managed through a globally coordinated regulation, then there's no reason why they cannot coexist with CBDCs. Very much like private money has always coexisted with central bank money in traditional finance. And second is from the market perspective. If and when CBDCs becomes really widely and easily available, it remains to be seen what users might actually prefer. Again, it depends on the design features of the CBDC and whether stablecoins can offer any value propositions that's not available in CBDC. The last thing that we want to see from a regulated perspective is for certain stablecoins, or indeed more generally crypto assets, to become popular, not because of their innovation or technological superiority, but because of their ability to use a technology wrap to conduct risky financial services without the right oversight that can protect both customers and also the broader financial systems. So subject to these caveats, I do see CBDCs having a potential to serve, for example, as a foundational or core layer for the DeFi ecosystem, whereas private stablecoins or other forms of private money, maybe with better programmability or with better offline functionalities, can ride off this core layer to provide innovative and efficient payment services for customers. And in that kind of world, for example, payments between different users within the same stablecoin system can be cleared through transfer among the e-wallets or within the apps, whereas payments between different stablecoin systems potentially could be cleared real-time through the CBDCs. Again, it's very early stage, and a lot depends on the evolution of both CBDC and DeFi. But I do think that public and private could always complement each other in promoting innovation and efficiency. That has been the case in traditional finance for many, many decades or even centuries. And I believe that this will also be the case in this new world of crypto and DeFi.
Thank you very much, Eddie. So Jill, back to you. Building on the discussion we've been having about stablecoins with Eddie, what do you think needs to be improved from current stablecoin arrangements?
Yeah, I think first and foremost, the current stablecoin market out there is in many ways, ironically, given the nature, the transparent and kind of real-time nature of cryptocurrencies broadly, it can be very opaque and untransparent to users what the differences are between the various stable coins on offer to them, and what the risks are that underlie those stable coins that are on offer to them. And so first and foremost, I want to differentiate between the different stable coins that exist out there, because they do have very different risk profiles. Stable coins today come in two kind of main varieties, or can be bucketed in two different ways, if you like. As Brian mentioned earlier, the first way is algorithmic stablecoins. that use sort of a rebalancing, an automated programmatic rebalancing, that's what keeps them stable, as it were, and pegged to a given asset price. Frequently, that's the US dollar, but it could be anything really. And then the other bucket or category of stablecoins that exists out there are one-to-one asset backed, or at least claim to be. Some of those claims are more legitimate than others. Or at least more transparent to users in terms of the audits and checks that have been done than others are in terms of the issuers of these stable coins actually holding, whether it's dollars or short-term debt assets or treasuries or what have you, on their balance sheet in order to maintain that asset peg. And even just between these two different varieties, you're taking on two very different types of risk. On the one side, you're taking on very sort of institutional counterparty risk. Does this institution that's claiming to be one-to-one backing this asset actually have the correct assets to manage that risk and correct systems for that on their balance sheet and within their systems? On the other hand, you're trusting basically an algorithm and the effectiveness of that and the ability of that algorithm to be stress tested in extreme market scenarios. And many of these things have now been around for 3 to 5 years, and that feels like a pretty good track record for those that have been able to withstand various market conditions. But that's very short, of course, in the grand scheme of things. Then within those two different buckets or categories of stablecoins, you have all manner of different types of institutions, developers, builders, so forth, backing them. You have different levels of oversight happening by the different jurisdictions, of course, in which each of these are operating. And then you also just have different brands, right, that exist. And so I would say, first and foremost, all of this, it's going to be impossible for me to try to encapsulate it in just a couple of minutes here, but you get a sense, I think, of the degree of complexity and the degree of optionality that exists out there. And first and foremost, there needs to be better education, better consumer protection, again, around all of this, better transparency around what these stablecoins actually offer, what they mean for consumers, what the risks are that come along with them. And what all of that really boils down to, as Eddie mentioned, is better trust in the system, or at least better options for improved trust for consumers. And so you can probably segue that quite nicely, I think, Beiju, into how CBDCs might be able to offer that better trust in certain scenarios.
Absolutely, but just before that, do you think stablecoins are able to provide safe settlement for DeFi users?
I think if done correctly, absolutely. And, I think that we need to define what we mean probably by safe settlement, but at least in those ways that I just described, in terms of the improved trust around what the value of the stable coin actually is, what's backing it, what's holding it up, what it's pegged to, who's providing that guarantee. In all of those ways, I think that CBDCs could offer an improvement for users. I think that the risks, and again, this is a bit dependent on the meaning of safety here, the risks to CBDC, though, are also real. Where Brian mentioned, the politicization of the financial system, a lot of people have been, especially in recent weeks and months, turning to cryptocurrency as something that feels a little bit more outside of the politics of central bank issued fiat currency broadly, even digital currency aside. And so I do think that there are probably consumers in various parts of the world that would see that as a risk to using CBDCs as a settlement layer as well. But I do think that, for the broad swath of the world who is operating within jurisdictions where they do have high degrees of trust in their governments and in their financial systems, or indeed perhaps it's not even in their own financial system, but in another financial system that suddenly they might be able to access in an improved way through stable coins being proliferated globally. I think that that's a very exciting opportunity.
And would the DeFi ecosystem need a CBDC or use CBDCs? And would the use of sovereign money undermine the principles upon which DeFi is supposedly founded?
It does sound a bit like an oxymoron, a central bank digital currency in decentralized finance. But I don't think that it's an oxymoron actually at all. I think that, to me, DeFi, when we talk about decentralized finance, it's important to remember what that term actually means. Why do we care in the first place about it being decentralized? I think what it offers is really openness and access, both on the innovation side and on the consumer side, as we discussed already, and also optionality. Decentralization offers builders and consumers, I think, much greater optionality than they would have if something is an edict by fiat that they must use X or they must do Y. And I think that a part of that optionality should be having the option to use a central bank currency, to use in many cases, again, what would probably be a really highly trusted asset from a really highly trusted institution. I do think that central banks do play that role. And I think that that's again a really exciting prospect for DeFi to be able to inject that sort of centralized trust in that way. On the flip side, do I believe that DeFi should only run on CBDC? Do I believe that that should be the only option for consumers? No, I don't, because I think that then that, again, would strip DeFi from some of its core principles and values. And I think that that's the subtlety there. I think that CBDC can absolutely play a role in DeFi, and a very exciting one, and unlock actually a lot more innovation and benefits than we've even seen today. But I don't think that CBDC should, by fiat, be the only thing underpinning DeFi.
Right. Well, thank you very much, Jill. So circling back to Brian now, having served in both the private crypto world and as a regulator, where and how do you see the payments landscape evolving in DeFi?
Yeah, well, so Beju, I would say a lot of that answer depends on what you think the answer was to the question you were asking Eddie and Jill. And so, if you think that we're going to migrate to a world where CBDCs exist, then the role that DeFi plays in payments is probably limited. Whereas if you think the stablecoins wind up winning, then I think DeFi over time becomes a significant advance for a whole bunch of reasons. So let me just back up and give you my very quick and maybe somewhat controversial answers to the questions that Eddie and Jill answered, because I think I'll answer them just to be provocative a little bit differently. First of all, I think that DeFi already relies on sovereign money in the sense of fiat money, right? So stablecoins are backed by sovereign money. In general, I'm not talking about the makers of the world, but I am talking about the USDCs of the world. They're backed by sovereign money that is held as bank deposits. But bank deposits are obviously the mid-stage of money that was created by central bank activities and then transmitted on the transmission belt of the banking system. So I would argue that, yes, it relies on sovereign money, but not on CBDCs. The important question, I think, is your second question, which is, can CBDCs and stablecoins coexist in a world of DeFi? I'm going to take the other side of Eddie's answer. I'm going to say that they cannot. And the reason I say that is because the core battle going on right now in monetary policy, whether it's stated or unstated, is the question of how we're going to move away from a bank-focused financial system. There are two ways you can move away from a bank-focused financial system. One is you can rely on technology innovations that allow the central bank to command and control the financial system by itself without needing commercial banks to serve as a transmission belt as they historically did. And I would argue that they historically needed banks to do that because of a lack of technical ability to directly influence the money supply and ultimately the payment system. And then the other main contender for sort of the future is a world in which user-controlled products win. But in either case, there's great pressure in both directions to move away from a commercial bank-focused model of the economy. One is to have, again, governments dominate that through central bank digital currencies. The other is to have users dominate it through stablecoins that they directly control, which transact on blockchain versus through the traditional banking system. But the idea that both of those paradigms can coexist in a stable way for a long period of time seems to me unlikely. And so the answer to your question of what does all this say about the payment system has a lot to do with whether central bank digital currencies take over, in which case we won't need DeFi as part of the payment system. At that point, you will have a central command and control system for payment clearing. And we sort of see what that looks like. I come back to the Canadian trucker protests as an example of, when governments take over the system at that level, they can determine what gets paid and what doesn't, what remittances get canceled and what don't, et cetera, et cetera. And in a stablecoin dominated world where you're transacting on permissionless, public blockchains, the government has no ability to do that. So I think the effect long-term on the payment system depends almost entirely on the answer to your last question, which obviously is a debatable question.
Right. And do you think that any reliance on stablecoins rather than in the future on CBDCs change the risk profile of DeFi?
Well, so again, I look at risk in terms of compared to what. So, stablecoins have certain risks that CBDCs don't have. For example, like bank run risks are a thing that exists. So, to Jill's comment earlier, that not all stablecoins are created equal in terms of are they really backed by legitimate, fungible, readily liquefiable assets. The answer is Tether has a different risk profile from USDC, for example, right? So you have run risk there. On the other hand, you have transparency risk, you have political risk and other kinds of things with the CBDC situation. And so it all depends on what you're optimizing for. And that is why I really do believe we're involved in this unstated sort of ideological struggle about, what do we do about the predictability and safety, but also sort of potentially anti-democratic and anti-libertarian bent of the CBDC model. There are obviously pros and cons to that, coupled with, or perhaps contrasted with, a stablecoin model, which is probably better from the perspective of individual consumer choice, but potentially worse from a systemic perspective. And so you have to decide what are you optimizing for in a world that may not offer you both paths at the same time.
Thank you very much, Brian. So we're in the final couple of minutes of this very insightful discussion. Before we wrap up, I'd like to ask each of you for a very quick reflection on what your co-panelists have shared in this session. First beginning with Brian, and then over to Jill, and then to Eddie.
Well, what I would say is, here's my very quick reflection. I think what I take from Eddie's commentary is that there are financial regulators in the world that are thinking deeply about the pros and cons of innovation in this space. And that's not the case with all financial regulators. I think many financial regulators have an ideological position or a status quo bias that makes it very hard for them to think in the sort of cost-benefit way that I'm hearing Eddie talk. So I'm very encouraged by that. Although I do worry that the G7 economies versus the G20 economies don't see things that way. So I'm super excited that there are people in the G20 that are broad-minded enough to do that. And when I hear Jill talk, what I'm hearing is capital allocators have an ability to make very smart choices here to optimize for diversification across multiple potential scenarios. And I think the world's probably a better place for having people like Jill in it. So those are my quick reflections.
Thank you, Brian. Over to you, Jill, for your quick reflections.
Kind comments, Brian. I think for me, one of the big takeaways is just how much opportunity there still is and how much, to what degree rather, DeFi still has yet to be formed. It's really still in the crucible. And I think that there are many points on which Eddie, Brian, and myself, Eddie and Brian, of course, being, two highly influential people in this space, I think that there are many points on which we're very much aligned, but I equally heard, perhaps in subtle and diplomatic ways, of course, ways in which we have slightly differing perspectives on where this all is going. And to me, that is both somewhat scary in the sense of how early all of this still is, but I think also really exciting in terms of the opportunity for everyone listening in today, everyone on this call, everyone speaking over the course of this week to get involved and really shape what the future of all of this looks like.
Thank you, Jill. Finally, to Eddie.
Well, I agree with Brian and Jill in that DeFi holds great promise in promoting innovation in finance. Of course, there are risks that might actually arise from DeFi, but like Brian said, I think it's only constructive to have an open mind in looking at this new form of finance. But I think the starting point is very new and it's still evolving. So I think the starting point has to be deepening the engagement between the regulators and the DeFi community. Like what Joe said, it could be there could be issues about us not really understanding it, but there also could be issues about builders and programmers not really understanding where the regulators are coming from. So I think the starting point has to be deeper engagement, so that we understand each other and try to see whether DeFi can actually bring us to new forms of finance that is both risk managed and can deliver new efficiencies to customers.
Well, thank you very much, Eddie, Jill, and Brian, for sharing your invaluable views and insights. I think today's debate has shown the complexity of this topic and the range of things that central banks and regulators will need to think about. So I'm sure this discussion will continue to evolve. So thank you very much for your time today. And to those attending this session, thank you for your time, and I hope you found it as valuable as I did. And stay tuned for the next session, which is in conversation with central bank leaders, which will discuss the evolving role of private digital currencies in the financial system of the future and how central banks should respond to continue ensuring monetary and financial stability. Thank you very much.